$63.85. That's where silver opened today. A few hours later, it was trading above $66 again. If you only looked at the metal itself, that's already a wild ride. But if you looked at silver mining stocks during that same window, you saw something even crazier. Moves nearly double the size of silver's own swing in both directions within the same few hours. Today, I want to show you something most silver content completely ignores. What happens to the mining companies that actually dig this metal out of the ground when these violent price swings hit? Because the mining stocks today didn't just confirm what happened to silver, they actually told the story more clearly than the metal itself did, if you know how to read them. We're also going to talk about a genuinely strange contradiction buried in this year's supply numbers that most coverage has completely missed. And what a sitting silver mining CEO said this week about where demand is actually heading. Let's get into it. This is OG Silver Stacker. Every video, something new, nothing recycled. Let's go. Let's walk through exactly what happened today, because the shape of this move matters just as much as the headline number. Silver opened sharply lower at $63.85, a drop of roughly 3.7% from Friday's closing level near $66.30. That's an aggressive opening gap, the kind that immediately puts everyone holding silver on edge the moment they check their phone in the morning. Within the first hour or two of trading, though, the recovery began. Silver clawed back above its Friday closing level entirely, eventually pushing past $66.40 before settling into a calmer range as the session matured. This kind of shape, a sharp gap down followed by a near-complete intraday recovery, is sometimes called a V-shaped reversal by chart traders. It's a specific, recognizable pattern, and it tends to carry a particular meaning. When a market gaps down hard and then completely reverses within the same session, it often suggests that the initial drop was driven by emotional, reactive selling rather than a genuine reassessment of value, and that buyers stepped in aggressively once the price reached a level they considered attractive. We touched on the mechanics of why these fast reversals happen in a previous video, but today I want to focus on a different lens entirely, what the mining stocks were doing while all of this played out. Here's a concept that I think every serious silver stacker should understand, even if you only ever buy physical metal and never touch a mining stock yourself. Silver mining companies behave like leveraged bets on the silver price, and understanding why helps you read their movements as a kind of amplified signal for what's happening in sentiment around the metal itself. Here's the simple logic behind this. A mining company has relatively fixed costs to dig silver out of the ground, things like labor, equipment, fuel, and processing costs that don't change much from day to day. If it costs a mining company, say, $30 to produce an ounce of silver and silver is trading at $65, that company is earning a $35 profit margin on every ounce. If silver drops to $60, that margin shrinks to $30, a drop of roughly 14% in profit, even though the metal itself only fell about 8%. If silver rises to $70, that margin expands to $40, a profit increase of about 14% on an 8% move in the metal. This is the core reason mining stocks amplify silver's price swings in both directions. Their profitability is far more sensitive to price changes than the metal's price itself. We saw this amplification clearly in recent sessions. One of the largest silver mining ETFs, which bundles together shares of major silver mining companies into a single tradable fund, dropped by more than 3.5% in a single recent session, even on a day when the metal itself moved by a noticeably smaller percentage. That fund has also been sliding from highs near $120 down into the low 80s over recent weeks, a far steeper percentage decline than silver's own pullback over the same period. This is exactly the leverage effect in action. And it's part of why mining stock investors experience an even wilder emotional roller coaster than physical stackers during exactly these kinds of volatile stretches. Let's actually put some names to this, because I think it makes the concept far more concrete than just talking about abstract mining stocks in general. The largest silver mining ETF I just mentioned holds a portfolio dominated by a handful of major companies. Wheaton Precious Metals represents the single largest position, making up over a fifth of the entire fund. Pan American Silver is the second largest holding, followed by Kerr Mining, First Majestic Silver, and Fresnillo rounding out the top 5 positions. Each of these companies has a slightly different business model worth understanding briefly. Wheaton Precious Metals doesn't actually operate mines directly. Instead, it uses a streaming model similar to the massive deal we discussed in an earlier video, where it provides upfront capital to mining operators in exchange for the right to purchase a portion of their future silver production at a fixed, heavily discounted price. This model tends to be somewhat less volatile than direct mining operations because Wheaton isn't exposed to the day-to-day operating costs and risks of actually running a mine. Pan American Silver and Kerr. Mining, by contrast, are direct mine operators, meaning they're exposed to the full range of operating costs, labor issues, and production risks that come with actually running mining operations. First Majestic Silver focuses heavily on Mexican silver production, one of the world's most important silver-producing regions, while Fresnillo, based in Mexico as well, ranks among the largest primary silver producers on the planet. When you watch this basket of companies swing more dramatically than silver itself during a day like today, you're essentially watching concentrated bets on Mexican and global silver production amplify every twist and turn in the underlying metal's price. Now here's something genuinely strange that I want to walk through carefully, because it's a real contradiction sitting inside the supply data that almost nobody's explaining clearly. Global silver mine supply is actually projected to reach decade highs this year. Read that again, because it sounds like it should be bearish news. More silver coming out of the ground than we've seen in 10 years. And yet, despite that decade-high mining output, the global silver market is still projected to run a deficit for a 6th consecutive year. How can both of these things be true at the same time? The answer comes down to just how enormous the demand side of this equation has become. Industrial fabrication demand, driven by electronics, solar, electric vehicles, and increasingly artificial intelligence infrastructure, combined with continued investment demand from both retail stackers and institutional buyers, has simply grown faster than even a decade-high mining output can keep pace with. This is actually one of the most bullish pieces of context buried in this entire story, once you think it through properly. If the silver market can't balance itself even with mine supply at its highest level in 10 years, that tells you the underlying demand growth has become genuinely structural rather than some temporary blip that a modest supply increase could easily fix. It would take an extraordinary sustained surge in mining output, well beyond what we're currently seeing, to actually close this gap. And as we discussed in a previous video, opening new mines or meaningfully expanding existing ones takes the better part of a decade due to permitting, financing, and construction timelines. So even this decade-high supply figure isn't enough, and there's no quick fix coming from the supply side anytime soon. Here's a piece of this story that I genuinely think deserves more attention. This week, the chairman and CEO of a silver mining company spoke publicly about exactly where he sees the strongest growth coming from on the demand side. His comments specifically highlighted artificial intelligence infrastructure, electric vehicle production, and power grid upgrades happening across the United States as key drivers behind growing silver demand, tied directly to broader efforts to boost domestic production of critical minerals. I think this perspective matters because it's coming directly from someone running an actual mining operation, watching real order flow and demand signals from industrial buyers in real time, rather than someone simply analyzing price charts from the outside. When the people closest to actual physical silver transactions are specifically pointing to AI infrastructure and power grid modernization as growth drivers, separate from the more commonly discussed solar story we've covered before, it reinforces the idea that silver's demand base is actually diversifying and broadening. Even as one piece of that demand puzzle, solar thrifting, has been getting smaller through the cost-cutting trend we discussed in an earlier video. Power grid upgrades specifically represent a genuinely under-discussed demand driver worth understanding. As countries work to modernize aging electrical infrastructure and expand capacity to support everything from electric vehicle charging networks to massive new data center buildouts, the copper and silver-based components used throughout these grid systems represent a steady, multi-year demand pipeline. That has very little to do with short-term price swings, geopolitical headlines, or Federal Reserve meetings. It's slow, unglamorous background demand, but it adds up significantly when you're talking about entire national infrastructure systems getting upgraded simultaneously across multiple countries. Let's bring this back to today specifically and use what we've learned about mining stock leverage to better understand the broader market's reaction to today's whiplash. If mining stocks had simply continued falling sharply throughout the entire session, even after silver itself started recovering, that divergence would have suggested that equity investors specifically remained nervous about the broader macro and geopolitical backdrop, even as the metal itself found short-term support. Mining stocks, after all, aren't just exposed to silver's price. They're also exposed to general stock market sentiment, since they trade on equity exchanges alongside every other publicly listed company, which means broader market jitters about war risk or economic uncertainty can weigh on mining shares independently of what's happening with the metal itself. Conversely, if mining stocks recovered alongside, or even more aggressively than, the metal itself once the initial panic faded, that would suggest a more complete, broad-based recovery in sentiment, with both commodity traders and equity investors reaching a similar conclusion that today's initial reaction had overshot reality. Watching this relationship between the metal and the miners over the coming days, particularly around Thursday's upcoming inflation data release we discussed in our last video, gives you a genuinely useful secondary signal, beyond just staring at the spot price of silver itself. When miners and metal move in confirming directions together, That tends to represent a more convincing, broadly shared market view than when they diverge from each other. I want to introduce one more useful concept here, something professional investors call beta, because understanding it helps explain why some of you watching this channel might be holding completely different types of silver exposure with wildly different risk levels, even though you think of yourselves as doing the same basic thing. Beta essentially measures how much an asset tends to move relative to some benchmark. In this case, relative to the price of silver itself. Physical silver, by definition, has a beta of exactly 1 to itself, meaning if silver moves up or down by a certain percentage, your physical holdings move by that exact same percentage in dollar terms. A silver mining stock, because of the operating leverage we discussed earlier, typically carries a beta well above 1 relative to silver. Sometimes 1.5 times or even 2 times the metal's percentage move in either direction. Junior, smaller mining companies, which tend to have thinner profit margins and higher operating costs relative to their revenue, often carry even higher beta than the larger, more established producers we discussed earlier. Why does this matter practically? Because if you're holding a mix of physical silver and silver mining stocks, you need to recognize that the mining stock portion of your portfolio is going to feel far more volatile and emotionally intense than your physical holdings during exactly these kinds of dramatic swing days. Some stackers prefer to keep their physical holdings as their steady, long-term core position, specifically because of this lower volatility, while treating any mining stock exposure as a separate, higher risk, higher potential reward satellite position that they're mentally prepared to see swing much more dramatically in both directions. Understanding your own beta exposure, in plain terms, understanding just how much more intensely your specific holdings are going to react compared to the simple spot price you see quoted everywhere, is a genuinely underrated piece of self-awareness for managing your own emotional reactions during volatile weeks like this one. Let's bring in one more comparison that helps round out today's full picture. While silver was swinging dramatically, gold's reaction to the exact same Trump-Iran headlines was noticeably calmer, moving in a much narrower range throughout the day. This connects directly back to the identity difference we discussed in an earlier video. Gold's demand base skews far more heavily toward central bank reserves, monetary store value buying, and large institutional allocation decisions that tend to move more slowly and deliberately, less prone to the kind of rapid, headline-driven whipsaw we saw in silver today. Silver's demand base, being roughly split between monetary and industrial uses, combined with a smaller overall market size compared to gold, naturally produces a higher beta, more volatile reaction to the exact same piece of news. This is actually one of the most consistent patterns you can observe across silver's entire trading history. During almost every major geopolitical or macroeconomic headline event, silver tends to move by a noticeably larger percentage than gold in both directions. Today was simply another data point confirming this well-established pattern. If you're someone who finds gold's relative calm more comfortable, that's a completely legitimate preference. But it's worth recognizing clearly that choosing silver specifically means choosing a higher volatility ride in exchange for, historically, greater potential upside during strong bull market phases. Exactly the trade-off we discussed back in our very first video on this channel. Let's pull together everything from today's deep dive into something genuinely useful for how you approach silver from here. First, start paying attention to mining stocks, even if you never plan to buy one yourself, simply as a sentiment gauge. When mining stocks and the metal itself move in the same direction with similar conviction, that's a more convincing signal than the metal moving alone. When they diverge significantly, that divergence itself is worth investigating before drawing strong conclusions from price action alone. Second, internalize the genuinely bullish nature of this year's supply contradiction. Decade-high mine production still isn't enough to balance the market. That's not a minor technical detail. That's a powerful signal about just how deeply structural this demand growth has become. And it should inform how seriously you take short-term price weakness driven by Fed headlines or geopolitical drama. Third, take note of where actual industry voices, like mining company executives, speaking directly about order flow and demand trends are pointing. AI infrastructure, electric vehicles, and power grid modernization represent a broadening, diversifying demand base that extends well beyond the solar story that gets most of the attention in casual coverage. Fourth, understand your own beta exposure clearly. If you're holding mining stocks alongside physical silver, recognize that you've voluntarily taken on a higher volatility, higher leverage version of the same basic thesis, and prepare yourself emotionally for swings considerably larger than what the simple spot price suggests. So here's the full picture behind today's crash then explode move. Silver itself swung dramatically, but the mining stocks behind that metal told an even louder version of the same story, amplified by the operating leverage built into how these companies actually make money. Buried inside this year's supply numbers is a genuinely striking contradiction. Decade-high mining output still failing to close a structural deficit. That tells you more about silver's long-term trajectory than any single day's headline ever could. And industry voices on the ground are increasingly pointing toward AI, EVs, and power grid upgrades as the next wave of demand, broadening the story well beyond solar panels alone. Today's wild swing wasn't really about silver being broken or unpredictable. It was silver and the companies that mine it doing exactly what they've always done during periods of heightened uncertainty, just with a little more amplification than the metal experiences on its own. If breaking down what's actually happening underneath these crazy price days is what keeps you coming back to this channel, hit that like button, subscribe so you don't miss the next one, and tell me in the comments, do you hold any mining stocks alongside your physical silver, or do you stick strictly to the metal itself? I read every comment, and I'll see you in the next one.